Stay with me because what just happened in the bond market is not the kind of event that announces itself with sirens and breaking banners. There was no dramatic crash, no single number flashing red across every screen. Instead, there was a pause, a hesitation, a subtle shift that professionals felt before they could fully explain it. Something that had always behaved one way suddenly didn't. And when that happens in the bond market, it matters more than almost anything else, because this is the foundation everything else is built on. For most people, bonds are background noise. Stocks get the headlines, crypto gets the drama, currencies get the politics. Bonds are supposed to be boring, slow, dependable. They are where risk goes to calm down. They are how governments borrow, how pensions function, how banks measure safety. When bonds move smoothly, the system feels stable, even if everything else is chaotic. When they don't, it's a signal that stress is traveling through the core of the financial system itself. What snapped wasn't confidence in a single government or a single policy. It was an assumption. For years, markets operated under the belief that certain reactions were automatic. If growth slowed, bonds would rally. If fear rose, yields would fall. If uncertainty spiked, money would flow into safety. That pattern trained everyone, from hedge funds to central banks, to respond the same way. Today, that reflex failed. Instead of behaving like shock absorbers, bonds hesitated, wobbled, and then moved in ways that forced traders to stop and reassess. The immediate explanations sound technical, even reassuring. Auction dynamics, liquidity conditions, positioning, temporary imbalances. But those explanations miss the larger point. Technical reasons don't break habits this deeply unless the underlying structure has already changed. What we're seeing is not a one-day anomaly. It's the result of pressures that have been building quietly for years, finally reaching a point where the old responses no longer work reliably. The bond market has been carrying contradictions for a long time. Massive issuance alongside tightening policy, rising debt alongside promises of discipline, central banks signaling restraint while still backstopping stability. For a while, those contradictions coexisted because trust filled the gaps. Investors believed that when things got uncomfortable, the system would revert to familiar patterns. Today suggested that belief is no longer universally held. This is where contrast matters. In past moments of stress, bonds were the place people ran to. Today, they were the place people questioned, not abandoned, not dumped in panic, but examined with a level of skepticism that hasn't been normal for decades. That shift in mindset is far more important than any single yield move, because markets run on expectations first and numbers second. When expectations crack, behavior follows. Large institutions begin reducing assumptions they once treated as fixed. Risk models get adjusted, correlations get rewritten. Hedging strategies that worked for years suddenly look unreliable. None of this happens loudly. It happens in meetings, in internal memos, in quiet reallocations that never trend on social media. But it reshapes how capital moves over time. What changed today is not that bonds suddenly became dangerous. It's that they stopped being unquestioned. That distinction is crucial. A market can survive volatility. What it struggles with is doubt about its role. When the safest asset no longer reliably behaves like a safe asset, everything priced off of it needs to be reconsidered. That includes mortgages, equities, currencies, and government budgets. This doesn't mean collapse is imminent. It means the system is adjusting to a new reality where old shortcuts no longer apply. Investors are being forced to think again instead of reacting automatically. That transition is uncomfortable, messy, and often misunderstood in real time. But it's also how major shifts begin, not with explosions, but with hesitation. Most people miss this because nothing dramatic appeared to happen, but professionals noticed. And when the people who depend on stability for a living start questioning their assumptions, it tells you something important is changing beneath the surface. Today wasn't about fear, it was about recalibration, and recalibration in the bond market is never trivial. What made this moment especially unsettling for people inside the system was how quickly familiar explanations stopped working. Normally, when bonds misbehave, there is a clean narrative ready to deploy. Inflation expectations shifted. A data print surprised. A central bank hinted at something. This time, those narratives arrived late and felt incomplete. Traders weren't just reacting to information, they were reacting to uncertainty about the framework itself. The rules hadn't been officially changed, but they were no longer being trusted. For decades, the bond market functioned as the ultimate referee. It disciplined governments by raising borrowing costs, rewarded credibility with lower yields, and transmitted signals faster than politics ever could. Central banks learned to listen to it, not fight it. Even when they intervened, they did so carefully, aware that credibility depended on the perception that markets still mattered. Over time, however, that balance shifted. Intervention became more frequent. Signals became more managed. Outcomes became less organic. The result is a market that looks deep and liquid, but behaves differently under stress. Today's hesitation reflected that difference. Participants weren't sure whether price movements were expressing genuine risk or merely responding to policy expectations that might change again tomorrow. When that ambiguity enters a market built on clarity, behavior changes fast. Another layer that few outside the bond world appreciate is how leveraged this market has become. Bonds are not just held, they are used as collateral, as hedges, as benchmarks for everything from derivatives to pension liabilities. When prices move unexpectedly, the effects ripple outward through balance sheets that assume stability. Even small disruptions can force adjustments elsewhere, tightening conditions in places that seem unrelated. That's why today's shift matters beyond bonds themselves. Equity valuations rely on discount rates derived from bond yields. Currency flows respond to relative interest expectations. Housing markets depend on long-term rates that trace back to government debt. When bonds lose their anchoring role, every connected market feels the tremor, whether participants recognize the source or not. Contrast this with previous periods of stress. During past crises, bond rallies were dramatic, almost reassuring. They told investors that while risk assets suffered, the core was holding. Today's move lacked that clarity. It suggested a market unsure of its own function, caught between inflation risk, policy uncertainty, and sheer volume of issuance that must be absorbed. Issuance is an underappreciated part of this story. Governments around the world are borrowing at a pace that would have seemed extraordinary a generation ago. That supply has to be digested by markets already saturated with debt. For years, central banks absorbed much of it, suppressing yields and smoothing volatility. As they step back, even partially, private buyers must step forward. Today hinted that this transition may be rougher than expected. What snapped then was not demand, but confidence in the transition itself. Investors are starting to question whether markets can absorb this supply without more explicit support. At the same time, they are questioning whether support, if it returns, would come with conditions that change the game again. Caught between those possibilities, hesitation becomes rational. This hesitation feeds on itself. When participants pause, liquidity thins. When liquidity thins, price moves become sharper. Sharper moves reinforce caution. This dynamic doesn't require panic to be dangerous. It just requires uncertainty to persist long enough to alter behavior. Today was a glimpse of that process starting. It's important to understand that bond markets don't need drama to send signals. Their language is subtle: a weak auction, a failed rally, a correlation that doesn't hold. These are the clues professionals watch for, because they reveal shifts before they become obvious. Today delivered several of those clues at once. None of this guarantees a crisis. Markets can adapt. New equilibria can form. But adaptation comes with costs. Volatility increases. Risk premiums rise. Borrowing becomes more expensive, not because of fear, but because of doubt. Doubt about rules, about backstops, about what happens next. Most people will only notice this later, when effects show up elsewhere. Slower growth, tighter credit, policy choices that seem constrained. By then, today will look like an early warning that few paid attention to. Not because it was hidden, but because it didn't fit the usual script. What changed today was subtle but profound. The bond market reminded everyone that it is not just a tool to be managed, but a system that reacts to incentives and beliefs. When those beliefs shift, even slightly, the effects accumulate. Today was not the end of stability, it was the end of complacency about how stability is maintained. The deeper implication of what happened today is not about timing the next move, but about understanding what kind of environment we are entering. Bond markets don't operate on emotion the way equities sometimes do. They operate on assumptions about policy credibility, fiscal restraint, inflation control, and institutional coordination. When those assumptions weaken, the market doesn't scream. It adjusts its posture. That adjustment is what we saw. For years, investors assumed that no matter how large deficits grew or how complex the global situation became, there would always be a mechanism to smooth the path. Central banks would calibrate, governments would refinance, markets would absorb. Today suggested that this chain of confidence is no longer seamless. It didn't break entirely, but it showed strain in a way that was difficult to ignore. What's especially important is how this intersects with future decision-making. Once participants recognize that bonds may not behave predictably in stress, they change how they use them. Hedging strategies evolve. Risk models become more conservative. Capital that once flowed automatically into government debt begins to look for alternatives. None of this happens overnight, but it accumulates. Over time, the cost of borrowing rises not because of panic, but because certainty has a price. This creates a feedback loop that policymakers are keenly aware of. Higher borrowing costs tighten financial conditions. Tighter conditions slow growth. Slower growth increases political pressure. That pressure, in turn, influences policy choices that may further unsettle markets. Navigating this loop requires precision. It also requires trust. Today showed that trust can no longer be taken for granted. Another consequence is how this moment reframes the role of central banks. They have spent years trying to regain control of inflation while also preserving financial stability. Those goals are increasingly in tension. Supporting one can undermine the other. When bonds hesitate, it exposes that tension. It forces a choice between credibility and control, between letting markets adjust and stepping in to manage outcomes. Markets are starting to sense that this balance is becoming harder to maintain. That awareness changes behavior even before any official action is taken. Participants begin to price in uncertainty itself. Volatility becomes structural rather than episodic. Risk premiums stop compressing the way they once did. The era of effortless absorption gives way to one of selective participation. This is why today matters, even if nothing dramatic follows immediately. Structural shifts announce themselves quietly. They appear first as inconsistencies, as moments where familiar patterns fail to assert themselves. Over time, those moments string together into a new normal. The old playbook doesn't stop working all at once. It just works less often until relying on it feels irresponsible. For the broader economy, this translates into a more constrained environment. Governments face harder trade-offs. Stimulus carries higher costs. Debt sustainability becomes a real conversation again, rather than an abstract one. Policy flexibility narrows. These constraints don't end growth, but they change its character. Less driven by leverage, more dependent on productivity. That transition is rarely smooth. Most people will encounter this shift indirectly, through higher mortgage rates that don't fall as expected, through markets that feel less forgiving, through economic narratives that emphasize limits rather than expansion. When those experiences accumulate, they will be traced back to moments like today, when the bond market quietly signaled that something fundamental was changing. It's tempting to look for villains or simple explanations, to blame a single policy or a single institution. But the reality is more complex. The system evolved into this state over time, shaped by incentives that favored short-term stability over long-term resilience. Today wasn't about assigning blame, it was about revealing consequences. The most important takeaway is not fear, but awareness. Understanding that the bond market is no longer operating under the same assumptions allows investors, policymakers, and observers to recalibrate expectations. It encourages caution where complacency once ruled. It invites realism in place of faith. Something snapped today, not because the system is failing, but because it is changing. And change, at the core of the financial system, always carries implications far beyond the moment it first appears. Those implications will unfold gradually, unevenly, and often without clear attribution. But they will shape the landscape going forward. Ignoring that signal doesn't make it go away. Understanding it doesn't guarantee safety, but it does restore agency. The bond market has spoken in its own language, quiet, measured, but unmistakable to those listening. The question now is whether the rest of the system is prepared to adapt, or whether it will keep assuming that tomorrow will behave like yesterday. History suggests that moments like this are remembered not for what happened immediately, but for what they set in motion. Today may well be one of those moments.